After much anticipation, Fed Chairman Ben Bernanke finally delivered his speech at the Jackson Hole Symposium. Did he disappoint? Judging from the reactions in the markets, he didn't. The biggest reactions were firstly found in treasuries, where 10-year yield dived to close at the week's low of 1.562%, down from the prior week's 1.678% and compared with August's high of 1.863%. 30-year yield also tumbled to close at 2.684%, also at the week's low. That compared to the prior week's close of 2.792% and August's high of 2.984%. Also, gold rebounded strongly to close at 1,687.6, compared to the intra-week low of 1,647.1. Both are a clear reflection of intensified expectation of additional quantitative easing from the Fed. Stocks did rebound too, but both the Dow and S&P 500 were limited well below August's high, suggesting that investors might not be too convinced about the effect of another round of easing, and are hesitating ahead of an important month. In the currency markets, the weakness in US dollar, Japanese yen was most apparent after Bernanke's speech, but the Kiwi and Aussie were the weakest currency in the week as a whole. Technically, the dollar index's development last week affirmed the case of medium-term reversal and raised the chance of falling back to 80 and below in the near term. In other words, Euro-US dollar's rally will likely continue following broad-based weakness in the greenback. But we tend to avoid European majors again based on the uncertainties ahead. Meanwhile, further intensification of QE3, as triggered by economic data like ISM indices and the non-farm payroll this week, should benefit the yen most. And based on recent weakness, should disappointing economic data pressure stocks, the Aussie and Kiwi will be hit hard again. Indeed, the Aussie is vulnerable to a gap-down opening, as China's PMI manufacturing released on Saturday showed deeper than expected contraction at 49.2 in August. So overall, we'd continue last week's strategy in preferring to short Aussie dollar, Japanese yen in the near term. September will be an important month to the markets considering the key events scheduled. Starting with the US first, Bernanke didn't hint on when the Fed will implement a new stimulus program, and what to do in his speech, monetary policy since the onset of the crisis, at the Jackson Hole Symposium. But he did somewhat set the stage. He noted that there is no net improvement in the unemployment rate since January. And, unless the economy begins to grow more quickly than it has recently, the unemployment rate is likely to remain far above levels consistent with maximum employment for some time. And more importantly, Bernanke said that the stagnation of the labor market in particular is a grave concern, not only because of the enormous suffering and waste of human talent it entails, but also because persistently high levels of unemployment will wreak structural damage on our economy that could last for many years. Grave concern was cited by some analysts as the strongest words Bernanke has ever used regarding the dire situation in employment. Remember that in the minutes for August's Federal Open Market Committee meeting, many members judged that additional monetary accommodation would likely be warranted fairly soon unless incoming information pointed to a substantial and sustainable strengthening in the pace of the economic recovery. The overall situation makes this Friday's August payroll report even more important. Markets are expecting the U.S. job market to grow by 127,000. And it's speculated that a sub-100,000 number will add tremendously to the odds of Fed easing in the Federal Open Market Committee meeting on September 13th. Also, the Fed will release revised projections at Bernanke's post-meeting press conference. There are also a number of key events in Europe in September. At this point, we're still facing many questions. Will the European Central Bank restart a bond-buying program? Will they target to cap a yield, or in what form will the bond buying be in? Will Spain apply for a sovereign bailout? And could Greece secure the next tranche of the bailout fund and successfully seek extension to its fiscal adjustment program? Hopefully, we'll get clear answers to these questions this month. The first key event will be this Thursday's ECB meeting. Expectations are high on Draghi to deliver the details of the prospective bond-buying program as he cancelled his trip to Jackson Hole Symposium due to a heavy workload. In an article titled, "The Future of the Euro, Stability Through Change," Draghi pointed out that fulfilling the central bank's mandate sometimes requires us to go beyond standard monetary policy tools. Current financial markets are fragmented or influenced by irrational fears, and that affects the transmission of the ECB's monetary policy. He also said that such blockages need to be fixed to ensure a single monetary policy and therefore price stability for all euro area citizens. However, we'd like to point out again there have been talk that the ECB could announce the program only after Germany's constitutional court's ruling on legality of the European Stability Mechanism on September 12. Meanwhile, the ECB could cut the key interest rate by another 25 base points to a new historical low of 0.50% this week. Then, after the German court ruling, Eurogroup and finance ministers will meet on September 14th and 15th. Using the European Stability Mechanism to purchase bonds should be discussed there. There will also be discussion on Spain as well as on Greece. On the topic of Greece, Troika will deliver the final report on Greece's reform efforts. The report will be crucial in determining whether Greece could at least get some easing on program requirements ahead.